Have you ever stopped to think about how the money just sitting in your savings account could actually help build, say, the next big tech company? Or how massive corporations get the cash they need for huge new projects? Well, today we're going to pull back the curtain on the securities market. It's the powerful, often misunderstood system that connects people with money to companies with big ideas.
At its very core, the entire financial market, all of it, really just exists to solve one single fundamental problem. And to really get it, you have to look at it from two different perspectives, two sides of the same coin, if you will. So here's the challenge. Picture this. On one side, you've got people like you and me with some savings, and we'd love for that money to grow, to do more than just earn a tiny bit of interest in a bank. And on the other side, you've got these ambitious companies with brilliant ideas, but they need cash. They need capital to make those ideas a reality. So how on earth do you build a bridge between the two?
Well, the answer turned out to be a pretty groundbreaking invention, the security. This is the financial tool, the concept that literally forms the bridge between those who have the savings and those who are ready to build.
So what is a security really? When you strip it all down, it's just a formal agreement. That's it. The issuer is just the company that needs the money, and the investor is the person who's providing it. You can think of a security as the official contract that makes this whole relationship work. So in essence, a security is what magically transforms that idle cash, those savings, into a productive investment. And it's way more than just a handshake agreement. It's a standardized contract that gives you, the investor, very specific rights, like a claim on future profits or guaranteed interest payments, all in exchange for putting your money to work.
Okay, so when you decide to provide your funds, you basically have two main options, two paths you can take. You can either become an owner or you can become a lender. Let's break down exactly what that means.
This slide really lays it out perfectly. On the one hand, you have equity, which you probably know as stocks. When you buy a stock, you're literally buying a slice of the company's pie. You become a part owner and you share in the ups and downs. Then you have debt, things like bonds. Here, you're not an owner. You're basically acting like the bank. You're lending the company money so they can, say, buy a new oven, and they promise to pay you back with interest.
Let's dig into this a little more. If you own an equity share, say in a company like Reliance, you're a shareholder, an owner. Your potential return could be huge through growth and dividends, but it's also unpredictable and definitely riskier. And here's the kicker. If the company fails, you're the last one in line to get paid. On the flip side, if you own a bond, you're a lender. Your return is a nice, predictable, fixed interest payment. The risk is much lower, and this is critical. If the company goes under, you get paid back before any of the shareholders do.
So we have these securities now, stocks and bonds. But where do they actually come from? And where do people go to buy and sell them? Well, this all happens in a marketplace that's split into two very distinct stages.
Think of it like this. The primary market, that's the factory where the securities are born. It's the very first time a company offers its shares to the public. Then you have the secondary market. This is the huge, bustling bazaar where all those securities that were already created are then traded back and forth between all the different investors. A perfect example of that primary market in action is an IPO, which stands for Initial Public Offering. You've heard of these. It's that huge moment when a private company decides to go public. Think about the Zomato IPO back in 2021. That's when they sold their shares for the very first time to raise a whole bunch of fresh capital. Now, the secondary market is what most of us just call the stock market. We're talking about places like the National Stock Exchange. This is where you go to buy and sell shares of companies like Reliance or Infosys that were created a long time ago. And this market provides something called liquidity, which is really just a fancy way of saying it gives you the super important ability to sell your investment whenever you want to. And it's so important to understand that you absolutely cannot have one of these markets without the other. They are completely inseparable. I mean, the primary market creates all the new securities, sure. But without the secondary market, think about it. Why would anyone even bother buying them in the first place? Investors have to know there's a place where they can eventually sell. They need that exit plan. Okay, so we've seen how all the different pieces fit together. But let's zoom out. What's the big picture here? Why does this entire system matter so much? Well, because it's nothing less than the engine that drives the entire economy. You see, the securities market does something pretty remarkable. It takes all of our collective savings, all that money that might otherwise just be sitting around, and it channels it into productive companies that can actually build things, innovate, and grow. It helps the best and most successful ideas attract the capital they need. It gives us investors the freedom to buy and sell easily. And ultimately, this whole system is what fuels the economic growth that creates jobs and income for all of us. So there you have it. That's the foundation of the securities market. It's the bridge between your savings and the world's biggest ideas. You've just taken the first step, and now you know the basic rules of the game. So the only question left is, what's your next move going to be?